Welcome, folks. Welcome to today's Bobcast from Bob Benny Wealth Management. I'm Bob Benny.
I'm Jesse Thompson.
And this is Thursday, August the 22nd. And our Bobcast topic for today is the 2024 election, what investors need to know. And this has already been a very volatile election year as far as the news and that sort of thing, even before the events of the last month or so. But as we get closer and closer to the election, it's going to continue to get crazier and crazier. It's a constant news cycle. Nowadays, with 24/7 cable news and the internet and our phones and everything, we can be, if we allow ourselves, be constantly deluged with news, and the news is full of scary things, fear, that can make you fearful. And that's what the news does, is the more they can make you fearful, the more you're going to keep watching. And that's what they're in the business of, is to keep you paying attention to them so they can continue to feed you their ads and make more money. But it does make people nervous. So
yeah, people get really nervous about the stock market during an election year because I think there's like this just cloud of kind of anxiety over everything during an election year, especially since everything started to become 24/7. It's no matter whether you're on your phone, on social media, or whether you have the TV on, there's just stuff everywhere all the time about it. And because of that, people kind of have this perception that the stock market is also scary during an election year, or that the stock market doesn't do well during an election year. And that's just not true. So the first thing that we're going to talk about is we're going to look at some historical perspective of how the stock market performs during election years typically. So stock market during election years. Bear with me. Okay, so over here in the right-hand corner, hopefully we're not in this corner for you, but hopefully you can see, I'll tell you about it. This is the S&P 500 index. So the 500 largest companies on the New York Stock Exchange, their annual returns during a presidential election year, the averages. So this is going from 1928 till 2020. Obviously, that was the last election year that we had. The average return when a Republican was elected president for that year, average annual return was 15.3%. The average annual return when a Democrat was elected was 8.5%. And over all of those election years, the average annual return was 11.58%. Now, for a little bit of comparison, the average return of the S&P 500 during all years, including election years and non-election years, is around 10%. So really, during an election year, the market on average does a little bit better than it normally does. It doesn't do worse like most people think it does. Most people think that, oh no, it's an election year, what do we need to do differently? And we'll kind of talk about maybe some things that you can do later, but what you do not do differently is get out of the stock market, because the stock market is usually good during a presidential election year.
So we also have some data on here on the left side, a chart that's showing the performance of the S&P 500 since 1933, depending on whether it's a Democrat president with a Democrat Congress, a divided Congress, or a Republican Congress, versus if it's a Republican president with a Democrat or Republican or divided Congress. And what you basically see is that, you know, if it's a divided Congress or a Republican Congress with either kind of president, it appears to be, in the upper double digits, or 12-13% or better. So we're just trying to give you some history to think about, because this volatility is normal. It's normal for the stock market period, but it seems to get a little bit more volatile during election years, and especially close to the election, especially the last couple of months. But remember, the bottom line for the value of your stock market investments is the earnings of the companies. And by and large, the earnings of the companies are relatively strong. And that's what has been keeping on causing the stock market to go up. Now, emotions can cause people to sell because of fear, which may cause the stock market to go down, but that's a good opportunity, actually. So
if you expect, I think the main points here are expect that there's probably going to be some volatility, especially in September and October as we get closer to the election. But usually, historically, that volatility clears up as soon as the election is over and things are settled and people are like, okay, well, now I know that the uncertainty is gone. I know who's going to be in office and I can plan for that.
So let's talk about how potential policy changes, depending on click your slide or what, potential policy changes can affect your investments
and your tax situation. So the biggest part of this equation, I think the biggest thing is that President Trump enacted the largest tax cuts in history when he was president that went into effect in, I believe, 2018.
Right.
And those are set to expire at the end of 2025. And the main three that have boosted the market and the economy and are probably a big reason why our economy is still doing okay right now, in spite of the current administration, is these three things. So the first one is that Trump reduced the individual tax rates and also doubled the standard deduction. So for a married filing jointly couple, this went from $13,000 to $24,000 in 2018, and now it's $29,000. So a lot of people had to had to itemize if they wanted to get deductions, a significant amount of deductions before. And now a lot of people, the standard deduction is so high that they don't even have to itemize because it's so much higher than it was.
Simplified their tax returns substantially.
So the second thing is that he doubled the estate tax exemption from $5.6 million per person to $11.2 million per person. It's currently $13.61 million per person. So just so you know, like for a couple, that's over $26 million. And why this is significant for people is that this is the amount of money that you can pass on to your kids without having to pay estate taxes. And it's also significant because the gift tax is tied in with this.
Right.
So this is the amount of money that you can gift total over your lifetime without having to pay gift tax as well. So that's significant and important.
So the biggest, though,
when it comes to the stock market,
the biggest thing when it comes to the stock market, though, is Trump's tax cut in 2018 reduced corporate income tax rates from 35% to 21%. 35% to 21%. It put that money right in the corporation's pockets. And the corporations, they don't really have pockets, they have owners, and the shareholders are the owners. And so it automatically increased the profits of every corporation substantially. So the Biden-Harris administration doesn't like these tax cuts, and they want them to allow them to expire in 2025. That's just next year, where they're automatically going to expire unless they're renewed. And so they want them to expire. And I just want to show you what that means on a flip chart. Do the math for you, because companies' values are based, their actual value, their real value is based on their earnings, based on how much profit they're making. So if I take a company, let's say this company, and we'll do it like it's a local company, but it doesn't matter a small company, but it doesn't matter whether it's a small company or large company, it's the same effect. Let's say that this company is a company that makes $100,000 in gross profit. You can see that on the screen? Yeah, $100,000 in gross profit. With a 21% corporate income tax rate, they have to take that away. The government takes the 21,000 away, netting $79,000 in after-tax profit. That's the value of the company, not the value. That's what the company's value is based on. And so more profit, more value, less profit, less value. Actually, most companies on the stock market are worth, 20 times that. 20 times that number.
Multiple.
It's called a multiple. So 20 times $79,000 is how much, Jesse? Jesse's calculated.
1.58 million.
1.58 million in our little example. So if this was a gigantic company and this was $100 million or $100 billion, whatever it is, it's all the same thing. So now let's see with this, when these taxes go up, if the tax cuts are repealed, we have to take away $35,000. That's 35%, 21%, 35%. So that leaves the company with an after-tax profit of $65,000 times 20.
It's 1.3 million.
It's 1.3 million. So what happens is the profit here goes down by 18%. Okay. 18%. The value of the company, though, also goes down. The real value of the company also goes down by this amount right here. The difference between this and this is 18%. And that's the thing that's really important for the stock market and investors in the stock market, is that if corporate income tax rates go up from 21% to 35% or anything, if they go up, that's increasing the cost and decreasing the profit of the company and devaluing the company. So that's very important.
And some other things that Harris has just come out and proposed is that she wants to add more regulations to lower prices or cap prices on groceries and on housing. So basically, she's proposing that we artificially rig the supply and demand cycle. And in idea, maybe that sounds nice to some people, that there's going to be prices capped when they go to the grocery store. But the way that works out in reality is never actually good for the consumer or the supplier. It actually hurts both. So kind of free market 101 also is that the more regulations that a company has to abide by, the more expensive that it is. The cost of doing business goes up, the more regulations that there is. And another thing that's kind of funny is that she's proposing that we put these price caps and do all these things to lower prices. But the reason that prices are so high is not because of corporate price gouging. It's because of the inflation that the government created in 2020 and that the Biden administration created with all of their spending.
The only thing that the real result of price controls anytime, anywhere, wherever they do it in the world, is it causes shortages. So that's what the result is. And what were you going to say about?
Oh, I heard this great Ronald Reagan quote in the last couple of weeks that said, the 9 most terrifying words in the English language are, I'm from the government and I'm here to help. And isn't that
so the government causes the problem? The government causes the problem with all the money they created out of thin air, increasing the money supply by 40% in about 3.5-4 years. And then they're going to come and try to fix it by controlling. So don't trust the news. Our motto is don't trust the news media and don't trust the government or politicians.
Okay, so moving on, let's talk about what you can do during this election year and maybe when we get to some more market volatility, and what you shouldn't do. Here's a quote.
Do's and don'ts during these times. So
the first thing that you should and shouldn't do is you should expect volatility, you should stay invested, and you shouldn't get out of the stock market.
You shouldn't panic. That's what we're here for. We're non-panic people. And so if you or your friends start getting nervous about the economy or the stock market or what you're hearing on the news, call us. Call us or email us, or call us, and we'll talk about it. You can call us anytime.
So we talk about this quite a lot on our webinars and when we talk to clients, but there have been so many studies shown that if getting out of the market to try to avoid the being in the market while it's going down hurts you over the long run. It hurts your returns over the long run more than it helps if you were to get out just in time to miss the dip, because you never know when to get in. And we'll kind of show that here in a second. But
and it also, she said the long run, it hurts you in the long run. It hurts you in the short run too, because oftentimes the best days in the market immediately follow the worst days in the market.
Right. And we just saw this with this most recent worldwide global sell-off that the media had everybody freaked out about. The market was above what it was before that sell-off within like days.
Yeah. It came back, started coming back the day after the so-called sell-off. And, the savvy investors,
to get out.
It was a mistake if anybody got out, and the savvy investors bought when it went down. Mm-hmm. They didn't sell.
So specifically related to election years, let me show you a study again, kind of on this market timing concept. So something that's interesting to note is that people that want to go to cash during a election year are super common. Money market funds, so that's like the cash fund in an investment account. You can have money market funds in the bank. They get a super small amount of interest typically. The holdings in those go way, way up during an election year because people get so nervous, but that's a mistake. And this is a analysis of 23 election cycles since 1932. It's a hypothetical $10,000 investment, and there's 3 different investment scenarios, 3 different investors here that we'll talk about. So the first person invested. So this is showing what this is showing. It's showing an investment over the entire 4-year election cycle, starting in the election year. Okay.
So it would have been like this one would have been starting
in
January 1 of this year.
And they've averaged the returns of the S&P 500 over these different election cycles to come up with these numbers. Okay. So the first person stayed fully invested. They started with $10,000 that they invested on January 1st of the election year, and they stayed invested the whole time. They got the greatest return. Okay. The second person made $1,000 contributions each month of the election year, January through October, and left their money in there for the entire election cycle, all 4 years. Okay. The third person was a nervous Nelly, and they thought, election years are kind of scary, and I'm kind of nervous about the stock market during election year and who's going to get elected, and I'll just wait to find out who's going to get elected and until things settle down, and then I'll invest my money. So they stayed in a money market account in cash on the sidelines until January 1st after the election year. Okay. They got the worst return. Now, this over here shows how many times each scenario or each strategy was the best outcome versus how many times it was the worst outcome. This one where people stayed out of the market was the worst outcome most of the time, hands down. The best outcome most of the time was just staying and being invested right away and staying invested the entire time. So that's just another
data point
that proves staying invested is so much better than trying to get out and get in and time things right. And this is how it works for people in reality when they try to time the market.
So I've been doing this for 29, 30 years. And I've watched people do this over and over and over. So let me use this cleaner. So I'm going to draw a graph of the stock market, a pretend graph of the stock market. So it just does this, right? And over time, we end up averaging this, okay? But what happens when people get nervous and they sell because of fear, or they sell because the market's going down and they try to time the market. They think, well, you know what, I'm nervous about the market and all this uncertainty with, for instance, with the election and I've been watching the news too much and they're scaring the hell out of me. And so I'm just going to go on the sidelines, and we'll have a drop like what happened a few weeks ago, or maybe it's a sustained drop. They get to a certain point and it's called capitulation, and they sell right here. It's gone down this much, they can't take it. It's gone down, so they sell. So then the market might go down a little bit more and they think, oh, I'm really smart. I sold right here, and so I didn't lose this. And then the market turns around. The market turns around and it comes back up to here, which is where it was where they sold. And they think, well, you know, I should have bought back here. I should have bought back here at the bottom, which nobody knows when or where the bottom is, of course. And they're thinking, well, I'm going to wait till it goes back down again, but it doesn't go down. It just keeps going up, 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 up. And so at some point then they finally decide, usually after it's gone up quite a bit, they finally decide right here to buy. So they missed out on all this gain back from here to here, and they've actually ended up losing money. And that's why when people with high emotions try to manage their own money and they don't have financial advisors that are no panic, like Jesse and I, that are no panic people, they don't end up earning what they should be earning because they sold when the wrong time to sell was, and they bought when the wrong time to buy was. Where am I now?
Here.
So one of the, thank you.
You can talk. I'm gonna move this out of the way.
Yeah, so if you or your friends find yourselves getting nervous about the election or about some volatility in the market, best advice we can give you is take a break from the media. You know, with today's 24/7 news cycle that you can watch cable news 24 hours a day, and then with our phones and everything you can get from websites and internet and news feeds and all like that, people are getting overwhelmed with news, and it's scary news. And the news is designed to be scary because fear sells. The whole purpose of the news media's purpose is not to tell you the truth. By and large, the mainstream media is not to tell you the truth. In fact, they have a bias. It's a proven bias, but their real purpose, the way they make money, is by you continuing to watch their shows or read their stuff or listen to them on the radio. That's how they make money, is getting you to continue to pay attention until you get to a commercial or whatever. And so they're going to sell fear, and our advice to you is don't buy it. Don't buy it. Limit both the amount of news that you take in and the source of your news, because so many of them are dishonest, and that will help you avoid the anxiety and the fear
that might prompt you to make bad investment decisions or financial decisions. A lot of times when there's volatility in the stock market or when the stock market goes down, people ask, what can I do? Or what should I do? So we talked about absolutely what you should not do is get out of the market and sell and go to cash, or think that now is the time to move into a more conservative investment, because that is not the time.
Right.
The things that you can do, strategies you can do during volatility, the first thing that you can do is, if you have a lot of money that's in like traditional IRA or 401k, you can do a Roth conversion when the market is down. It's a really smart time to do it when the market's down. When you do a Roth conversion, the amount that you convert to Roth is taxable as income to you the year that you do that. So when it comes April of the next year and you go to do your taxes, you'll owe income tax on whatever amount you did the Roth conversion for the year prior. Well, if you're converting while the market is down, that amount is going to be less that you end up owing taxes on. And then once you have it over in the Roth IRA, when the market comes back up, all that growth is going to be tax-free along with all the growth in the future. So that's a great thing to do when the market is down.
Great strategy.
Another thing that you can do when the market is down is if you have accounts that are non-retirement accounts, so a regular investment account that's not an IRA or a Roth IRA or 401k, those types of investments, you can sell things that are at a loss while the price is low to offset other gains from maybe things that you sold prior or other investment income. So that's another
You
thing.
can take advantage of the market being down by selling something at a loss, maybe a bigger loss than it otherwise would have been before the market went down.
Yeah, something that you kind of maybe wanted to get rid of anyway, or that wasn't super valuable, you can
Right.
do that then. The last thing is if you have cash on the sidelines, it's a great time to put it to work when everything is on sale. So, you know, to buy when other people are fearful and the market is down is the smartest thing, the smartest time to buy. So those are things that you can and should do when the market is down. So the next thing that we're going to talk about and the way that we're going to end is with some good news. So I want to show you guys one more chart here. Good news.
Good news.
So this chart shows the growth of a hypothetical $1,000 investment in the S&P 500 starting back at 1933. These different colored times are different party presidencies.
The red's Republican and the blue is Democrat. And you see over time, basically the market keeps going up. Doesn't really care whether it's a Democrat or a Republican, it keeps going up.
So the main point of this is that every election year seems like we think that, you know, the market's going to go to hell in a handbasket if a certain party gets elected. But there is checks and balances in our Constitution that were put in place to protect our freedoms and protect the free market system and capitalism. And that's why no matter who is president during this time that the stock markets continue to grow, and that as long as those remain in place and as long as capitalism and the free market system rule in our country,
as long as capitalism survives, the stock market's going to do fine. As long as capitalism survives. Now, if capitalism doesn't survive, then it's not going to matter, is it? Because the alternative to capitalism is socialism or communism, and they just come and take your stuff. So it doesn't really matter. I know that sounds kind of far-fetched or whatever, but it's the truth. So do you have anything else to say about good news?
Well, just the good news is our country's been through so many elections before. We don't know what's going to happen, but even if Harris gets into office next year, we don't know what's going to happen between now and the end of 2025, or if, you know, what's going to happen with future tax increases or decreases or regulations for sure.
We don't know what's going to happen with the House and the Senate either.
Right. But we are going to be watching everything. And if there's adjustments that need to be made, as far as investments go or strategies go,
we're going to make it.
We'll be on it.
We'll be on it. So you don't have to worry about it. So, now we wanted to give a little bit of encouragement. So everything's going to be all right, folks. And the encouragement comes from God's word, comes from the Bible. And this is a great verse out of Philippians chapter 4, verses 6 and 7. I love this. Just think about this. If you start getting anxious or nervous about what's going on in our country or about anything for that matter, read this verse and read it over and read it over and read it over, read it out loud. It says, do not be anxious about anything, but in every situation, by prayer and petition with thanksgiving, present your request to God. And the peace of God, which transcends all understanding, will guard your hearts and your minds in Christ Jesus. We're all going to be okay, folks. This country's going to be okay. God has his hand on this country. He's proved that, and he has his hand on us. And we're just going to be okay. So if you know anybody that is feeling anxious or antsy about the election and other investments, and they need a calming voice, have them give us a call. We have a plan for our customers Depending on what ends up happening, we have a plan, and we're on it, like Jesse said. This Bobcast will be replayed on YouTube and be available sometime tomorrow or whatever. So your friends can watch it if you want to send them to it or whatever. And we have a Bobcast every month, and we're just here to help. We're here to help you, your families, your friends. And if there's anything we can do for you, please give us a call.
Thank you very much. Have a great day.